All right, let's get right into it. Welcome to the Explainer. Today, we are absolutely putting the market's lazy, superficial analysis on trial. Because honestly, so often we hear the exact same recycled narratives, the same surface-level assumptions that just lead investors completely astray and, frankly, destroy capital. Today, we're looking at a 1,000 crore institutional investment report on a company called eClerx Services Ltd. And we are going to completely tear apart the assumptions, ignore all those flashy PowerPoint stories, and look purely at the cold, hard economic truth. Look, if you think AI will destroy outsourcing companies, you might just be analyzing the wrong businesses. We hear it literally all the time right now, right? AI is going to wipe out service jobs. Outsourcing is totally dead. But that whole narrative completely assumes that all service businesses are just these vulnerable, commoditized headcount vendors, just selling bodies and seats. Well, today, we're going to firmly prove exactly why that assumption is fundamentally flawed when you actually target the right asset. Okay, let's dive right into this. Part 1. The AI complexity paradox. Before we even look at eClerx itself, we absolutely have to understand the macro environment that's just suffocating global enterprises right now. The world is completely drowning in data, and it's driven by three massive, irreversible shifts that are creating pure operational chaos. First, digital transformation across all sectors. Every single bank, retailer, and telco company is digitizing, and someone actually has to manage those chaotic new systems. Second, AI adoption. Now, contrary to popular belief, AI doesn't just magically make operations disappear. It completely changes them. It creates massive complexity, stuff like data labeling, workflow redesign, and constant exception management. And third, intense cost pressures. Everyone's demanding way more output for a much lower cost. Put all those together, you don't get the death of services. You get a massive structural demand for high-level, complex outsourcing. But here is where the market commits its primary offense. Section 2, the market's BPO illusion. So the lazy consensus just buckets our target into a low-value category. They immediately think of traditional BPO. You know the type, a pure headcount business, terrible pricing power, crazy high attrition, and super replaceable labor. Now, if that's what you're buying, your portfolio has absolutely zero moat. But eClerx Services, it's a totally different beast. It is an embedded operational intelligence platform. We are talking high-value analytics, highly complex process intelligence, and incredibly deep domain trust, especially in areas like financial services, telecom, and digital commerce. Their clients aren't just buying people from them. They are buying outcomes. They're buying operational dependency. And let me tell you, dependency compounds. Which brings us to the numbers. Section 3, forensic financial reality. Let me be incredibly clear here. Conference calls, management buzzwords, and slick presentations, they do not matter anymore. We are looking purely at economic truth. Over the years, this company has just churned out consistent double-digit sales and PAT CAGRs, yet its market cap sits super comfortably under 1 lakh crore rupees. That establishes right out of the gate that the asset size is perfectly within the strict limits for a really massive, scalable institutional deployment. It is sitting in the absolute perfect sweet spot for generating alpha. Next up, check out their balance sheet. Their debt to equity is less than 1. It is essentially a net cash balance sheet. And importantly, we looked close, there are 0 shady extraordinary items propping up these numbers. This is so critical because it proves that the company's really impressive returns, they're completely organic and real. They aren't artificially inflating a single thing with dangerous leverage or financial engineering. A clean balance sheet like this is exactly what keeps your capital safe from going to 0. Now, when we look at valuation, the PEG ratio is sitting comfortably below 1. And even if you compare their PE against the broader industry PE, it remains incredibly attractive. Remember, the PE ratio compares valuation against growth, right? So being under 1 means the growth-adjusted valuation is surprisingly low. Finding an elite, cash-rich compounding asset that isn't already priced for absolute perfection is rare. It basically means we aren't overpaying for the incredible quality we're getting here. Look at this. They boast an operating profit margin of greater than 20%, and that flows right down to a super robust net profit margin as well. Listen, maintaining margins this high in the service sector, especially where you don't own patents or some massive intellectual property, is brutally hard. Doing it consistently across multi-year cycles, that signals true structural operational quality and serious pricing power. What's really fascinating here is their return on capital employed. It consistently exceeds 20%. Since eClerx runs a totally asset-light model, meaning they don't have to go out and build massive, capital-intensive factories just to grow, This metric proves some undeniable economic efficiency. Every single rupee they reinvest into talent and capability is just generating these elite, highly efficient returns. And the return on equity, also greater than 20%. So the absolute crucial point here is because we already confirmed they have negligible debt, this massive return on equity is coming directly from pure business quality. It's totally organic. It's not the result of some clever accounting tricks or leveraged risk. Okay, here is the absolute kill shot of our financial forensic analysis. Operating cash flow tracks closely and consistently right alongside profit after tax. In service businesses, profits can sometimes just be a complete illusion, hidden away in unpaid receivables. But here, the profit actually becomes cash. These earnings are backed by real, recurring cash flow. The numbers here are just incredibly clean. Which brings us to Section 4, stress testing the thesis. Look, blind defense is exactly how capital gets destroyed, so we have to actively try to kill our own thesis, using a very strict institutional risk matrix. These are the strict failure scenarios. If ROCE, or the operating profit margin, structurally drop below 20%, we exit. If cash flow ever diverges from profit after tax, which would indicate earnings manipulation, we exit. We also actively monitor the shareholding pattern. If smart institutional money suddenly flees, or if client concentration risk spikes because a top client leaves, we exit. If management repeatedly misses their execution guidance, we exit. Knowing exactly what will break the business is how you protect your downside. Now, when we probability weight the expected stock CAGR, the base case models a really solid 18 to 24% return purely on stable execution. If AI operations really accelerate, our bull case pushes that well past 30%. But the true value of this whole analysis is that even in a worst-case bear scenario with unexpected budget cuts, the downside protection is incredibly solid, hovering right between 8 and 15%. So while a massive upside is totally possible here, what you should really take away is the predictable downside protection that secures your wealth. And that brings us to Section 5, the final verdict. So after completely ripping apart the narrative, demanding real cash flow verification, and intensely stress-testing our risk matrix, the prosecutor's ruling is in. eClerx Services stands not as some generic vendor, but as a core digital compounder totally worthy of serious capital. But you never just deploy a 1,000 core position emotionally. It requires a strictly disciplined, phased playbook. Phase 1 is a 250 core proof position, just to test the thesis with real market exposure. Phase 2 adds another 250 crore, but only upon total confirmation of margin stability. And finally, Phase 3 scales up with the remaining 500 core, and that's strictly triggered by the actual monetization of AI capabilities and client expansion. This is a strategy based entirely on proven execution, not hope. So, I'm going to leave you with a final provocative question. Are you going to keep chasing those flashy, high-risk stories? Or are you finally ready to invest in a cash-rich operational compounding engine? The market is so full of hype and loud narratives right now, but real institutional wealth is built on process-driven operators who allocate their capital rationally. It's absolutely time to reevaluate your investment framework and start running your own forensic screens. Thanks so much for joining us for this explainer, and we'll catch you next time as we dive into another complex topic.